Good morning. Welcome to YouTube channel of CA Shashi Gupta. Today I am going to discuss with you important aspects about a recent judgment of NAFRA which is dated 8th of January 2024. This particular judgment is about a real estate infrastructure company, a limited company, and the financial statements were under scrutiny uh, by NAFRA on the information received from Serious Fraud Investigation Office, which is known as SFIO. The various issues raised in this particular order are about the suspicious transactions in the company and the group company, then round tripping and layering of transactions, inflated sales and purchases, siphoning of funds, huge funds to the tune of 671.48 crores, diversion of funds to the tune of 645 crores, and finally, the most important thing, the going concern aspect. Now, in this particular judgment, uh, the as per the details available on the order, the engagement partner failed first of all on various accounts, and first of all and the foremost and the most important is the evaluation of going concern concept, which is as per SA 570. Now, in this particular company, there were huge losses year after years. For example, in the first year, it was to the tune of 2.19 crores, then it was 3.29 crores, and then finally 91.58 crores. So, over a period of 3 years, the company was incurring losses year after year, and the volume of loss was increasing. And this particular aspect really leads to the conclusion that the affairs of the company are not running smoothly and the existence will be in doubt. The second aspect in this particular case was the negative cash flows, and the amount was to the tune of 60.95 crores. When the uh, cash operating cash flows is negative, again the question will arise on the liquidity of the firm and whether it will be able to meet its liabilities in coming future. Third aspect in this particular case was the default in the payment of cash credit and term loan facilities which the company had taken. And again, the amount was quite heavy. It was to the tune of 132 crores and 127 crores respectively. So when the company is unable to meet its current liabilities or the term loan liabilities, then again the question of going concern creeps in. Next point, which was disclosed, which was observed, was about the uncertainty of recovery of debtors, and that too about 32% of the total assets of the company, and the amount was about 240 crores. And the conclusion was on the basis of non-availability of external confirmation as has been laid down in SA 505. Then another aspect was the evaluation by engagement partner on the impairment of investments in subsidiaries and associates. And that again was very huge amount to the tune of 157 crores, and it amounted to more than 20% of the total assets. Another aspect which was discussed is the long delay in the projects of the company. The projects which the company was undertaking, it was taking undue long time in completion of those projects. And unless the projects are completed in time, the running or the continuation of the business is definitely under question. Then weak financial controls, internal financial controls with respect to, as we discussed, about the trade debtors, physical verification of inventories and fixed assets, sales, purchase, sale of property and equipment. So all these aspects were putting a doubt as far as the going concern concept of the company was concerned. Then the engagement partner uh, was not able to prove the sufficiency and appropriateness of the audit work, audit planning, which is required under SA 300. The engagement partner also lacked in creation of the audit documentation as has been laid down in SA 230, the most important. So the document file, the audit file which was presented, that was silent and that was not complete in all respects, which proves that the engagement partner had taken due care, proper audit programs were made, who was responsible for what work, what was the nature, what was the timing, and what was the extent of the audit procedures to be performed. So, and then after this was done, who reviewed it? A second person review is also required, as has been mandated. And then similarly, in case of listed companies, the quality review, EQR, is also required, which was also EQC was also required, which was not there. So these factors also contributed in against the engagement partner. Then another standard which says that those observations, the observations of the engagement partners, are required to be communicated with those charged with governance, SA 260 and 265, and there was no proof in the audit file about such communication with those people. Then the engagement partner was also lacking in demonstrating that whether the appropriate level of materiality and performance materiality as per SA 320 were established and the audit was conducted according to that. So unless until the materiality level has not been defined, no audit can be considered as to be complete. Similarly, another important aspect in this particular case was that there was no proof in the documents about physical verification of the inventory, and the engagement partner contended that due to that the premises was sealed by the economic offense wing of the government, they were unable to have a look on the documents, and as such he was unable to comment. Similarly, he also contended that he was not able to visit the premises of the company for physical verification as on the close of the financial year. Now, as far as the auditing practices are concerned, it is a clear concept that in case the auditor, for one reason or the other, is unable to present himself as on the close of the financial statement date, then the physical verification can be carried out subsequently also. And the transactions in between the period of the date of the balance sheet, financial statement, and the date of actual physical inventory verification, those transactions can be analyzed and come to a conclusion. And then the engagement partner contended that this particular aspect was well reported under the CARO paragraph. Here again, it is well established that if there is any adverse comment in the provisions of CARO, then those particular comments are required to be reproduced in the basis of opinion paragraph on the face of the main report. So here also the engagement partner was lacking in discharging his duties. Similarly, on the view of all these observations, the engagement partner had qualified the report, and the NAFRA board authority was of the opinion that under the circumstances, instead of a qualified opinion, and in the light of the engagement partner unable to obtain appropriate and sufficient audit evidence, the best thing would have been that the audit report would have been given a disclaimer instead of a qualified opinion, if not the negative opinion. So minimum disclaimer of opinion was required. Now here also one or more the issues which the engagement partner said in self-defense was that the financial statements were not adopted in the AGM. Number two, that the financial statements were signed after 12 months of the close of the financial year. And as such, he claimed that since the going concept in under the going concern concept, the validity period is about 12 months, the future 12 months. So according to him, the going concern concept is not applicable in this particular case. Here also the authority disagreed with the contention of the engagement partner and held that maybe the financial statements are signed after 1 year or 12 months. Even then, once the audited financial statements are issued, the engagement partner cannot absolve himself of his responsibilities. In view of all these things, the engagement partner was charged with negligence under clause 7, which says failure to exercise due diligence and gross negligence, and clause 8, which says that the engagement partner failed to obtain sufficient information necessary for expression of an opinion, or its exceptions are sufficiently material to negate the expression of an opinion. And finally, under clause 9, where the engagement partner failed to invite attention to material departure from generally accepted audit procedures. So, on these charges, the penal action was, announced on the engagement partner, which amounted to penalty of rupees 3 lakhs and debarment for a period of 3 years. So, friends, I hope the issues which are raised under this order are very important, and we as providers of attestation services must take due care. With this, thank you very much. We'll see you soon with another short such video in the common interest of the profession. Jai Hind, Jai Bharat.